Corporate finance. What is corporate finance? Corporate finance involves financial decisions that an organization makes in its daily business operations. Thus, the business decisions that involve the decision pertaining to the identification of sources of capital for funding corporations are corporate financial decisions. Corporate finance departments are charged with governing and overseeing their firms' financial activities and capital investment decisions. Such decisions include whether to pursue a proposed investment and whether to pay for the investment with equity, debt, or both. They also include whether shareholders should receive dividends, and if so, at what dividend yields. Additionally, the financial department manages current assets, current liabilities, and inventory control. A company's corporate finance tasks are often overseen by its chief financial officer, that is the CFO. Corporate finance tasks or duties. Capital investments. Corporate finance tasks include making capital investments and deploying a company's long-term capital. The capital investment decision process is primarily concerned with capital budgeting. Through capital budgeting, a company identifies capital expenditures, estimates future cash flows from proposed capital projects, compares planned investments with potential proceeds, and decides which projects to include in its capital budget. Making capital investments is perhaps the most important corporate finance task that can have serious business implications. Poor capital budgeting. For example, excessive investing or underfunded investments can compromise a company's financial position, either because of increased financial capital. What is capital financing? Corporate finance is also responsible for sourcing capital in the form of debt or equity. A company may borrow from commercial banks and other financial intermediaries or may issue debt securities in the capital markets through investment banks. A company may also choose to sell stocks to equity investors, especially when it needs large amounts of capital for business expansions. Capital financing is a balancing act in terms of deciding on the relative amounts or weights between debt and equity. Having too much debt may increase default risk, and relying heavily on equity can dilute earnings and value for early investors. In the end, capital financing must provide the capital needed to implement capital investments. Short-term, what is it? Corporate finance is also tasked with short-term financial management, where the goal is to ensure that there is enough liquidity to carry out continuing operations. Short-term financial management concerns current assets and current liabilities of working capital and operating cash flows. A company must be able to meet all its current liability obligations when and as due. This involves having enough current liquid assets to avoid disrupting a company's operations. Short-term financial management may also involve getting or issuing commercial papers as liquidity backups. The three important activities that govern corporate finance are: first, investments and capital budgeting; second, capital financing; third, dividends and return of capital. Well, now let us have a look at the examples of corporate finance activities. While the following list of items is not too much or very exhaustive, these are the most common corporate finance activities which any organization undertakes: executing an initial public offering, that is the IPOs, An IPO is undertaken when a privately funded company decides to be listed on a stock exchange so that it can access funding from capital markets. Getting a credit rating. A good credit rating will often lead to better borrowing conditions. To achieve this, the corporate finance director will ask an independent rating agency to write a report about credit worthiness. Doing a bond issue. A bond is a form of long-term loan which is funded by the purchaser of the bond, the initial bondholder. Such bonds can be bought and sold in the public markets, and whoever holds the bond will receive interest and be repaid according to the terms of the bond agreement. Securing a loan from a bank. The terms of such loans are often either based on the company's credit rating or are asset-backed. If they are asset-backed, the bank can claim the company's property in case of default. Redefining and renegotiating payment terms with suppliers or customers. Developing and executing a dividend program for shareholders. And the people in the corporate world learn on their own through their experiences as to what is corporate finance more practically. Hope this might have given you a fair idea and you might have gone into deciphering the enigma of corporate finance. And yes, to learn more in future, please subscribe to the channel. Thank you.